Welcome to the Explainer. Today, we're going to talk about something that sounds, well, a little contradictory. The TFSA tax trap. We're going to dive into how your tax-free account can actually end up with a tax bill, and more importantly, what you can do about it. I mean, the name says it all, right? Tax-free savings account. You'd think that's a pretty clear promise. But here's the thing I found out. Tax-free doesn't always mean, tax-free. Exactly. It's not a myth. It turns out there are a few specific situations where the Canada Revenue Agency can and will step in and tax your TFSA. So let's get into what those are. Okay, so here's the game plan. First, we'll tackle this whole tax-free paradox. Then we'll hit the 3 big traps you really need to watch out for, what to do if you accidentally fall into one, how to ask for a tax waiver, and finally, your options if you just plain disagree with the CRA. So let's start with this paradox. Look, the whole point of a TFSA is that your money grows tax-free. And that's fantastic. But, and this is a big but, it only works if you play by the CRA's rules. You step even a little bit out of line and, poof, that tax-free magic can just disappear. So how do you get yourself into this mess? Well, the CRA has actually laid out 3 main situations, 3 traps that can land you with a tax bill. And trust me, knowing what these are is pretty much the best way to avoid them. Okay, let's break them down. The first one is what's called an excess amount. Basically, just putting in more money than you're allowed to. The second is making a non-resident contribution, so adding money when you're not living in Canada. And the third is holding a non-permitted investment, basically having something in your account that isn't supposed to be there. Let's dig into each of these. Okay, this first one, this is probably the most common mistake people make. It is so easy to lose track of your contribution room, right? Especially if you have a couple of different accounts. But the penalty? Wow. It's a 1% tax on whatever amount is over the limit for every single month it sits there. That can add up incredibly fast. Now, this next one is super important for anyone who's ever lived or worked outside of Canada. The key here is your official tax residency. If you put money into your TFSA while you're technically considered a non-resident for tax purposes, well, that contribution can get taxed. All right, and trap number 3 is all about what you're actually holding inside that TFSA. See, not every investment is fair game. If you hold something the CRA considers non-permitted, think like shares in a private company you have a big stake in, that can trigger some really hefty penalties. Okay, so what if you're listening to this and thinking, uh-oh, I think I did that? First, don't panic, but also don't ignore it. That is the worst thing you can do. There's an official process to follow to make things right. Your first move is to get familiar with a form called the RC-243 TFSA return. You can think of this as your mea culpa form. It's literally designed to help you figure out and report the tax you owe because of the mistake. And, with taxes, deadlines are everything. You have to file that RC-243 form by June 30th of the year after the year the mistake happened. So let's say you overcontributed sometime in 2023. Your deadline to file is June 30th, 2024. Don't miss it. Okay, but here's a little bit of good news. Just because you technically owe the tax doesn't mean you're guaranteed to have to pay it. If you can show the CRA that it was a genuine, reasonable error, an honest mistake, you can actually ask them to just waive the tax. And there's a bit of jargon here that matters. A waiver is when you ask them to forget the charges before they've officially put them on your account. A cancellation is when the charge is already on your record and you're asking them to take it off. Really, the only difference is when you ask. So, how do you do it? It all kicks off with a simple letter. You just need to clearly explain what happened and why it was a reasonable mistake. And here's a really important tip. You absolutely want to mention that you've already fixed the problem. Like withdrawing the excess contribution the moment you realized it was there. When it comes to actually sending this letter, you've got 2 options. Honestly, the fastest, easiest way is to do it online through your CRA account. There's a Submit Documents feature that works great. But if you're more of a snail mail person, you can still send your letter to the tax centers in either Sudbury or Winnipeg. Okay, so let's say you did all that. You wrote the letter, sent it in, and the CRA gets back to you with a no. You don't agree with their decision. What do? Well, it's not over yet. You still have some appeal options. Your first move is to ask the CRA to take another look, a second review basically. If that still doesn't go your way and you're not satisfied, your next step is to take it outside the CRA and file a formal appeal with the federal court. But hang on, there's a totally different scenario here. What if it's not about you making a mistake? What if you're convinced that the CRA made the mistake? You look at their notice of assessment and you think, nope, their math is just wrong. If that's your situation, you have to act fast. There is a very strict 90-day deadline. You get 90 days from the date on that notice of assessment to formally object to what they've calculated. This is a totally separate process from asking for a waiver, by the way. The official process is called filing a notice of objection. You can use Form T400A or just send a signed letter. What this does is it forces a formal review of your file by the CRA's Appeals Division. It gets a fresh set of eyes on the case. So look, after all this, the big takeaway isn't that you should be scared of your TFSA. Not at all. It's still one of the absolute best tools we have in Canada for building wealth. The point is to be smart about it. Knowing the rules, and just as importantly, knowing how to fix a simple mistake, is what makes all the difference. It's what separates a savvy investor from someone who gets a really nasty, expensive surprise. So the real question is, are you making sure your TFSA is truly working for you?